Everyone wants to get rich investing, but in 2025, most people are doing the exact things that quietly destroy their wealth. Not because they don't try hard enough, but because they don't know what's actually holding them back. In a year full of opportunity, these 5 mistakes can cost you the very future you're trying to build. Welcome to Invest Education Hub, where we turn smart investing into simple decisions. Stay with us until the end. This might be the most important financial reality check you'll hear all year. So let's just start with the big question right here on the screen. Are your investments actually built to survive a storm? You know, a recession, a sudden market shock? For way too many people, the honest answer is probably no. See, they're so focused on that explosive growth, but that focus often leaves them totally exposed. And this is where we need to talk about our portfolio's unsung hero, the bond. They don't make the flashy headlines, but believe me, they are the key to building that resilience.
And that leads us directly to the first and probably the most common mistake people make. It's what I call the stability blind spot. This is all about chasing growth while completely ignoring protection. Investors get so laser-focused on offense, hunting for those high-flying stocks, the next big thing, that they forget to build any kind of defense. They're all gas, no brakes, and that's a dangerous way to drive.
I want you to think of your investment portfolio like a high-performance car. On the left, you've got your stocks. That's the gas pedal, right? It's the engine for growth, pushing you forward, giving you that speed. But a car with only a gas pedal, well, that's just a recipe for disaster. That's where bonds come in. They're the brakes, over on the right. They're your engine for protection. They give you stability and control, especially when the road gets bumpy. You absolutely need both to get where you're going in one piece.
And this quote right here, it just says it all perfectly. Stocks may build your fortune, but bonds protect it. It just captures that essential balance you need for long-term success. Stocks are for growing your wealth, for building that fortune. But bonds, they're for protecting what you've worked so incredibly hard to build. And in today's world, that balance is more critical than it's ever been.
So we get it, right? Bonds are the portfolio's anchor. They're the antidote to all that crazy volatility. But how do these brakes actually work? What is a bond, really? Let's break this down and demystify it, because understanding this is the foundation for everything else we're going to talk about.
Okay, at its absolute core, a bond is just a loan. It's really that simple. You, the investor, are lending money to a borrower. That could be a big company or even the government. In exchange for your loan, the borrower promises 2 things: to pay you regular interest payments, which are called coupons, and then, at a set date in the future, to pay you back your original loan amount, the principal. You're basically acting as the bank.
Let's make this crystal clear with a quick story. Imagine the city of Fairview wants a new stadium. So, step 1, they issue a 10-year bond for $1,000. Step 2, you come along and buy that bond, lending the city your $1,000. Now for the next 10 years, this is step 3, the city pays you $20 in interest every single year. And finally, step 4, after those 10 years are up, the city gives you your original $1,000 back. See, it's that simple, predictable structure that makes bonds such a powerful and reliable anchor.
Okay, now that we're clear on what a bond is, we've got to tackle the second huge mistake: believing that all safe investments are basically the same. They are absolutely not. Lumping all bonds together is like saying all cars are identical. We have to decode our options, because choosing the right kind of bond depends entirely on your specific goals.
This little table here breaks down the 3 main types you're going to see. First up, Treasury bonds, issued by the US government. These are considered the safest investment on Earth, period. Next, you've got corporate bonds, issued by companies. The risk is a little higher, sure, but to make up for it, they usually pay you more. And finally, municipal bonds, or munis. These come from states and cities, and their superpower is that the interest you earn is often tax-free. So as you can see, there's a flavor of bond for every type of investor.
Now let's be real, buying individual bonds can be a bit complicated. So for most of us, the absolute easiest way to get this protection is through something called a bond ETF, an exchange-traded fund. Think of it like this. Instead of buying just one bond, an ETF is like a big basket that lets you own hundreds, even thousands of different bonds all in one single purchase. It instantly spreads out your risk. Some of the most popular ones are right here, like AGG for general market exposure, or TLT if you want to focus on long-term government bonds.
All right, let's dive into mistake number 3, completely ignoring the interest rate seesaw.
This is probably the one concept about bonds that trips people up the most, but it is the number one rule of how they're priced. Getting this is absolutely crucial for knowing when to buy and what to expect from your bond investments.
And this slide shows that seesaw perfectly. It is an inverse relationship. Look on the left. When market interest rates go up, any new bonds being issued have to pay more. Well, that makes your older bond with its lower rate look a lot less attractive, right? So what happens? As you see on the right, the price of your existing bond has to fall. You'd have to sell it at a discount to compete. The reverse is also true. When interest rates fall, your old bond that pays a higher rate becomes super valuable, and its price goes up.
So why is this so incredibly important right now, in 2025? Well, look at this. With inflation finally starting to cool off, the Federal Reserve is hinting that they might pause or even start cutting interest rates. Now, remember our seesaw? If rates start to fall, that means the prices of existing bonds could rise. This is a huge deal. It means that right now, bonds are offering this rare 1-2 punch: steady income from their payments and the potential for their actual value to go up.
This brings us right to mistake number 4, which is simply buying bonds without a plan. Look, a smart investor doesn't just throw some money at bonds and hope for the best. To really tap into their power, you've got to build a foundation, a clear, simple strategy that's built around your specific financial goals.
And here it is, a simple but incredibly effective 4-step plan. First, define your horizon. Are you saving for a down payment in 3 years or for retirement in 30? You match the bond's maturity date to your goal. Step 2, ladder your bonds. This just means you spread your money across different maturities, say 1, 3, 5, and 10-year bonds. This helps manage risk and gives you a steady flow of cash. Third, diversify your issuers. We already talked about this. Use ETFs so you're not putting all your eggs in one basket. And finally, the magic step, number 4, reinvest your income. You take those interest payments you're getting and use them to buy even more bonds. That's how you let compounding work its magic.
Okay, we have arrived at our 5th and final mistake, and honestly, this might be the most important one of all. It's underestimating the incredible power of psychology in investing. You see, the ultimate advantage of owning bonds, it has almost nothing to do with numbers or yields or prices. It has everything to do with keeping you calm when the market goes nuts. And this chart is the visual proof. Just look at the difference in the ride. On the left, you have a portfolio that's 100% in stocks. Look at those wild, heart-stopping swings in volatility, but now look at the right, a simple 60-40 stock and bond mix. The journey is so much smoother, the ups and downs so much smaller. And this is so critical because that smoother ride helps you avoid the single biggest wealth destroyer of all,
And that is fear. The greatest threat to your long-term wealth isn't the volatility itself. It's not the market crash. It's your own emotional reaction to it. It's that panic deep in your gut that screams, "Sell everything!" right at the absolute bottom. Bonds are the anchor that keeps you from making that terrible emotional decision. They provide the calm and stability you need to have the confidence to stay invested, even when it's scary.
And this quote just wraps it all up perfectly. Bonds won't make you rich overnight, but they'll keep you rich for life. And that, right there, is the true quiet power of fixed income. It provides the order, the predictability, and the psychological calm that every single successful investor needs to make it in the long run. Building wealth isn't about being perfect, it's about avoiding the traps that keep most investors stuck. If you can eliminate these 5 mistakes, you're already ahead of 90% of people trying to grow their money in 2025. Start consistent, stay disciplined, and let time and diversification work in your favor. If this helped you see your financial habits in a new light, like it, subscribe, and share it with someone who needs to hear this message. Here at Invest Education Hub, we turn financial complexity into clarity, one smart decision at a time.